As the evidence has mounted that active fund managers failed to beat their benchmarks net of fees, there's been a big move away from active fund management to passive fund management, where you're simply paying someone to track a benchmark quite cheaply. But there's one fund manager which has completely gone against that trend, and that's ARK Investment Management. And in this video, we're going to look at the reasons why that might have happened, but also look at how you can maybe recreate those kind of returns if you don't have access to ARK in your country. So if you do want to learn more about investment, remember, you can always join our online community. Then you get access to our Slack chat channel, and you can ask questions of me and other members of the community anytime you like. And you also get access to a large bank of video content, which is only available to members. You'll find a link in the description below me and above me. So now let's look at ARK Investment Management's funds in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Beside me here, you can see the 7 actively managed exchange-traded funds which are offered by ARK Investment Management. And these are sorted by decreasing order of assets under management, with ARK Innovation ETF being the largest by far. And the ticker for that fund is ARKK. And at the end of 2020, as I make this video, that had almost $19 billion of assets under management. And beside that column, you can see the year-to-date price change for those funds. And you can see that those are extremely high returns. And of course, that's part of the reason why I'm making this video. The inception date when those funds were created for 4 of the funds was in 2014. So that's ARKK, ARKG, which is the Genomic Revolution ETF, ARKW, which is the Next Generation Internet ETF, and ARKQ, which is the Industrial Innovation ETF. Now, if we look at the expense ratio for those funds, you can see that they're extremely high compared to passive funds, for example. The most expensive fund is 0.76% per year, and the cheapest one, which is the Israel Innovative Technology ETF, is 0.49% per year. But while returns are very good, nobody questions these very high fees. So let's look at some of those returns now. So beneath me here, you can see the quarterly returns for the ARK Innovation ETF. That's the really large fund, which has about 19 billion in assets under management. And the pattern that really stands out is that the returns were okay, with some very good quarters, but then some pretty bad quarters. But then from Q2 2020, there were some simply immense returns. And that's not just for the ARK Innovation ETF, it's true of the other 3 funds here as well. And of course, the catalyst for those very high returns was a change in behavior we saw amongst investors after the initial March sell-off in 2020. And during the rally that followed, many of the stocks which were favored by ARK Investment Management were also the ones which saw the best returns. Now, given the technological nature of many of ARK's investments, it makes sense to compare it with a benchmark like the NASDAQ index, which isn't pure tech, but it's dominated by tech. So in the graph that follows, I've subtracted the returns from the QQQ ETF, which tracks the NASDAQ. And the pattern we see now is very different. So for example, from 2015 to about 2017 Q1, there wasn't really much outperformance at all relative to the NASDAQ from the ARK Innovation ETF. And from the ARK Genomic Revolution ETF, there were 3 quarters where it severely underperformed the NASDAQ. In fact, there are only a couple of really great quarters for ARK Investment Management during this period up to about 2019. That would have been Q2 in 2017, and for the Genomic Revolution ETF, it would have been Q1 in 2019. But then in Q2, Q3, and Q4 of 2020, we see these huge outperforming periods. Now, because those returns were so good, we saw some extremely large amounts of money flowing into these ARK funds. So in this graph underneath me, you can see the actual money flowing into, those are the green bars, and out of the very small number of red bars from the ARK funds in total. And again, the pattern that we see is that after the March sell-off, when we saw those very strong returns for ARK funds, the money follows those returns. And gradually those inflows get bigger and bigger. There was a very short period of outflows here in September when we saw a slight tech sell-off, but then we finally build up to this crescendo of inflows towards the end of 2020. And in the last 7 months of 2020, there was almost an $18 billion inflow into ARK funds. And bear in mind the entire inflows for 2020 were only 19.6 billion. So it was very much skewed towards the end of the year. And Eric Balchunas, who's the ETF guy on Bloomberg TV, came up with this tweet in October 2020. And what he's done is rank the inflows by asset manager. Now, what we typically see at the moment is that Vanguard and BlackRock, who are the two big powerhouses of passive management, hoover up most of the assets under management. So up till October in 2020, Vanguard gained about $133 billion of new money. BlackRock got about $67 billion, but then out of nowhere comes ARK Investment Management, which had already got about $8 billion of assets under management. And as we've seen, ARK actually accelerated its rate of inflows towards the end of the year. So here you can see it catching up with JP Morgan's JPST fund to become the largest active ETF in the US. Now this is a remarkable achievement if you see where they came from at the beginning of the year. So now let's just go through some of the largest funds that they offer to see what their investment themes actually are. And we can start with ARKK, which is the ARK Innovation ETF. Now, as we've seen, this is the largest fund offered by ARK Investment Management. And you can think of this kind of like the umbrella fund, which contains all of the other themes embedded within it. So each of these 4 themes that you can see around me are the ones which are broken down into separate funds. And the most recently issued fund is the FinTech Innovation Fund, and that was actually created in 2019. And in a moment, we'll drill down into those individual themes by looking at those 4 funds. Before we go on to look at the individual funds, let's just look at the individual stocks which are in the ARKK fund, and in particular their returns in 2019 and 2020. So above me here you can see the 2019 returns. It doesn't actually start on January the 1st, 2019 because some of these stocks didn't exist at that time. So the Zoom IPO was on April the 17th, and that's when the prices start. And in fact, the prices start for Pinterest on the same day. But this kind of shows you what a normal year looks like for a growth tech fund like ARKK. Some of these stocks have done incredibly well, rising by more than 100%. But what also happened, of course, is that some of them didn't pan out. They had a bad year and they fell by around 50% to 65%. But as another example of what was really different about 2020, all of these stocks had positive returns except for one, which was LendingTree. Now, I don't doubt for a moment that they're good stock pickers at ARK, but this was just lucky. It isn't usually the case that you get all of the stocks in a portfolio except for one rallying by such huge amounts. So for the top performing stocks here, we've got just blowout returns of upwards of 500%. Now, if you expect the returns on a portfolio, even ARK's portfolios, to be like this in future, you will be disappointed. Now, active funds do publish the weightings of their portfolios. And in this bar plot, we're looking at the actual portfolio weights of the ARKK fund, which I found in the application ETF DB. And what really stands out is the very large concentration in Tesla, which makes up 10% of the portfolio. But looking at these top 10 funds, you can see that a very large proportion of the portfolio is concentrated in just a very few stocks. Now, is that risky? Yes, it is. Because if any one of these falls calamitously, then that's going to have a large negative impact on the returns of the portfolio. Now, the total number of stocks in the portfolio is around 50, but if we add up the portfolio weights for the largest 10 stocks in the portfolio, that makes up about 50% of the overall weights. Now, this concentration is a double-edged sword. Firstly, it shows that they have very high conviction bets in the stocks which they like, which is a good thing. But the downside of that is the concentration risk, which is that if there's a very large pullback in these tech-driven companies, then there could be a significant impact on the portfolio because it's not diversified away from these innovative stocks. And if we look at the top 20 stocks, that makes up almost 3/4 of the portfolio. So what we're looking at for all of these funds are high conviction, high concentration, and risky portfolios. Now that means that if you're the kind of person who's scared by a 40%, 50% fall in a fund, and at the first sign of trouble you'd pull out your money, this isn't appropriate for you. It could be a rough ride, and it won't always be like 2020. Moving on to their next biggest fund, which is the Genomic Revolution ETF, ARKG, all of the themes on which this fund are based orbit around this central idea, which is that we can now sequence the entire genome of individuals very rapidly. Not only that, or we can actually use DNA editing technology through CRISPR to edit out troublesome parts of a genome. That creates the intriguing possibility of targeted therapeutics for individuals. So for example, we could go to our doctor and they'd immediately have our entire genome in front of them, and they'd be able to know what our susceptibilities were for disease, but also the best way to treat that disease for us individually. And this has the possibility of revolutionizing agriculture. So when it comes to animal husbandry, it's very easy now to sequence the entire genome of your breeding stock to ensure that there's as much diversity as possible. So you can already see that there's a beautiful narrative that you could weave around these companies, which just makes this very attractive from financial journalists' point of view, but also for the people who are marketing these ARK funds. Something we're all very familiar with is the next generation internet themes. And the reason why it's familiar is that this is where we spend most of our lives nowadays, on the internet, either directly by looking at things like social platforms, such as YouTube, but also indirectly. So for example, none of us wants to be the target of a security breach. So cybersecurity is an incredibly important theme. And many of the applications we now use are based on cloud computing, where the central processing and storage could be anywhere, we just access it through our physical devices. And as each of us all have these mobile devices, we're generating huge amounts of data, which, somewhat controversially, companies can now use to target us for their marketing campaigns. And with the advent of technology, we've also seen the democratization of many aspects of our life. So we can now lend to each other and borrow via peer-to-peer lending. And it's no longer just our phones which are connected to the internet. Other devices which we use, such as our cars, but even appliances in our kitchen, are connected to the internet. So these sub-themes fit very clearly into the overarching theme of disruption, which ARK simply loves. And finally, the FinTech Innovation ETF, ARKF, applies the concept of disruptive technology to finance. So this would be things such as, how can we make transactions more rapid but also easier? Can we decentralize storage of those transactions through something like blockchain technology? Or perhaps we'd never face our bank directly, we'd do it through some kind of intermediary. Now this is particularly relevant in the United States because the banking system there tends to be more fragmented. In the UK we have fewer banks, and so it is much easier to transfer money, for example, from one side of the country to the other. But in the UK, there's also a slew of companies which are applying technology to these financial problems, making finance easier, cheaper, and more widely available to more people. Now, I'm not going to go through the individual stocks into which ARK invests because there are simply too many, but I will focus on one stock, which is Tesla. And the reason for that is that many of these ARK funds are heavily invested in Tesla. So ETFDB has a nice feature where you can look at which companies have the largest exposure in ETFs. And here are the largest ETF exposures for Tesla. So you can see this iShares US Consumer Goods ETF has the largest exposure to Tesla at around 16.4%. But the ARKQ fund isn't far behind at about 12%. And ARK Next Generation ETF is 10.3%. And ARK Innovation ETF, the largest fund, also has a very high weight of 10.2%. Now these three graphs are taken from the 2020 Q3 update from Tesla, and the numbers are generally going in the right direction. So the number of vehicle deliveries has gone up. It's gone up to 140,000 units in Q3 of 2020. The free cash flow is increasing, and most importantly, the net income has been positive for 5 successive quarters. Now the entry requirement for the S&P 500 is 4 successive quarters of profit. But the key question is, what is Tesla worth? And in order to answer that, we have to ask, what is Tesla? It's not just a car company. It's also an energy company. They produce batteries which are used in other applications. It's also a software company because in order to have this great tech which is built into their car, there's a lot of code which they write in order to make the car almost autonomous. They've also created huge gigafactories to produce batteries which are used by other companies. So I'd refer to a fantastic blog and a spreadsheet created by Aswath Damodaran, the Dean of Valuation, where he looks at various scenarios for valuing Tesla. And his very valid point in the article is that it really depends on how you see Tesla. What's your narrative? Is it just a big auto company? So if it carries on growing as it is now, it's going to be one of the largest auto companies in the world. If that's the case and it achieves the margins, investment efficiency, and cost of capital that's associated with a very large car manufacturer, then that would put its intrinsic value at somewhere between $21 and $67, depending on the type of revenues it generates, whether that's BMW type revenue, Daimler revenue, or Volkswagen Toyota type revenue. If instead your narrative is that it's some kind of techie auto company, so some kind of hybrid between a tech company and an auto company, then as a result it might have higher margins like a tech company, but the cost of capital would also be higher like a tech company. And those two tend to offset one another, which means the intrinsic price range would also be comparable to a big auto story. If on the other hand it's very much like a successful tech company like one of the FANGs, then its revenues wouldn't be so high because car manufacturers tend to have higher revenue, but its margins would be very high, above 20%. Unfortunately, its cost of capital would also be high as a tech company, and that pushes up its intrinsic value to somewhere between $90 and $420. But if you take the very best of every category, in other words, you have the revenue of Volkswagen or Toyota, you have a margin above 20% like a software company, and you have a relatively small cost of capital like an auto company, then that would put the intrinsic value at $420. And here I've overlaid the share price of Tesla since 2018 with 4 of those scenarios. And you can see that up to 2020, it was trading pretty much in line with the big auto story. But then in 2020, something very remarkable happened after the crash in March. The price had already started increasing, but then it started to increase at an incredible rate. And it blew well past the intrinsic value of the best possible case. So what's pretty clear is that for Tesla, and in fact I suspect many of the other companies owned by ARK, the valuations have got very much out of line with intrinsic value. But there's a huge amount of financial history that tells us eventually stocks snap back into line with their fundamental value. If their earnings can't grow quickly enough to match their price, eventually there's a day of reckoning. We don't know when it's going to be, but we do know it's going to happen at some point. And if that happens to ARK's investments, then there could be significant downside from where we are today. And that brings me on to some of the problems I have with ARK funds. We've already seen that the concentration for ARK Innovation ETF is such that the top 10 funds make up about half of the total investments. But it's not just true of that fund, but it's true of almost all of ARK funds. The Israel Innovative Technology ETF is the only one where there isn't such high concentration. Now, is that a risk? Yes, it is. At some point, there will be a pullback in some of these frothy stocks, and there's going to be a significant impact on the value of many of these funds. And also, we've seen this movie before, many times. Eric Balchunas makes a nice analogy with a supernova, which is when a star dies. And for a very brief amount of time, it puts out a huge amount of energy and light, but then after that, it very rapidly diminishes to an ember. And the supernova example he gives is the CMG Focus Fund. And if we zoom in on that graph, you can see it more clearly. And the story was very similar. In fact, the returns of this fund were even better than that of ARK. Over this period between 1998 and 2007, the fund gained over 930%. And as a consequence, lots of money flooded into the fund, as financial journalists lauded the fund manager as a genius. But then in 2008, the fund fell in value by 50%. And very rapidly, that 8 billion in assets under management fell to 3 billion. And after that, it generated fairly mediocre returns. But it's still the case that over its lifetime, it's beating the S&P 500. But what's clear is that people have very long memories when it comes to losing money. And at the moment, it's only got $300 million of assets under management. And the narrative in the media about this fund has turned from very positive to extremely negative, such as this headline which says legendary fund manager goes from penthouse to outhouse. Now, I don't think this is necessarily going to happen to ARK investment funds. Who knows? Cathie Wood could be the next Warren Buffett, but it's extremely unlikely. What's much more likely is that there's going to be some kind of new environment in which these funds simply don't do as well. And once the returns start to fade, we'll see very large outflows, and at that point it'll take a lot of work to restore trust in the funds. And just as money flooded into the fund quickly when returns were good, I suspect the outflows will be brutal. Now, if you're based in Europe or in the UK, these ARK funds are not available because they don't have a key investor information document, which is a regulatory requirement on this side of the pond. But there is a UK fund, an investment trust, which is very similar both in investment philosophy and its returns to the funds managed by ARK. In the top panel here, I've got the price of the ARKK fund, and in the bottom panel, the price of the Scottish Mortgage Trust Fund. Now, they're extremely similar leading up to 2020, but even during the crash and the subsequent rally, they're also very similar. If I rescale the graphs so that we track the value of $1 invested in ARKK or £1 invested in Scottish Mortgage Trust from November in 2014. Now, the greenish line is Scottish Mortgage Trust and the red line is ARKK. And the two are very similar all the way up to the very end of 2020 when Scottish Mortgage Trust starts to slightly underperform relative to ARKK. And if we look at the portfolio of Scottish Mortgage, you can instantly see why they're so similar. Top of their league table is Tesla, where they have a slightly higher allocation than even ARKK, at over 12%. In fact, Scottish Mortgage has held Tesla for more than 5 years. But many of the good things about Scottish Mortgage are similar to the good things about ARK investment funds. And at the risk of looking like a Teletubby, this is a video I made about Scottish Mortgage a few years ago. Now, one of the things which is great about Scottish Mortgage and ARK is that they have high conviction in their stocks. Once they find a stock they like, they buy it in size, and they hold it for a long period of time. Perhaps unlike ARK, they're very committed to low fees. So when their assets under management grew very rapidly, they reduced their management fee. It would be great to see ARK do that too, but I think it's unlikely. Plus, as an investment trust, it has a board of governors who are very well educated in the themes in which the fund invests. That way they have regulatory oversight and active oversight in how the fund invests. And they're there to ensure that that happens in the interests of the shareholders. So although Scottish Mortgage isn't exactly like ARK, it's very similar. And I love reading its annual report. It's just got a great summary of these investment themes and why they think the companies in which they invest are in a good place to monetize those investment themes. Now, if you've got through to the video at this point, I'm guessing you're enjoying it, in which case, why not support us? You can now do that directly via YouTube by clicking on join, which should be underneath this window. And there's also a link in the description so you can join us. And if you do that, you get a great badge next to your name when you make a comment, or if you join us on one of our YouTube lives. And we'd really appreciate it because you keep us independent. Another alternative, if you don't want to go for a fund which is like ARK, is to try and recreate it yourself with single stocks. Now, of course, that's never going to be a perfect match because the weights are changing all the time. That's the point of active management. It's active, but you can do a fairly good job of matching the returns of some of these funds. So to illustrate that, I'm going to add more and more stocks to a portfolio and see how closely it approaches the ARKK Funds returns. Now, I don't have the historic weights, but I'm going to use the most recent weights to see how well that approximates returns since the March lows in 2020. So let's start off with just one stock, which is Tesla, and you can see that that's actually outperformed the ARKK fund quite significantly. If we add one more equity, and here I've added RockQ to the portfolio, and these are in the same weights in which you'd find them in the portfolio, such that they add up to 1. And if I flip between those two graphs, you can probably see that the returns are getting more accurate in the sense that they're getting lower and closer to the ARKK line. If I add one more equity, they get even closer. And if I had 10 equities, as we know that makes up about half the portfolio, the returns get more similar. In fact, we're still outperforming ARKK as it happens. Now, this isn't easy. You're going to have to keep an eye on what the fund is buying and selling, but there are many YouTube channels which actually publish that for the ARK funds. Plus, you're going to have to rebalance, so it's not going to be easy. But you can do a reasonable job of matching the returns fairly well. But remember, you'll be matching them on the way down as well as on the way up. So that was my brief overview of ARK funds. I hope you'll find it useful. I don't think I could really do them justice in the time I've got, but I do like a lot of things about them as a fund manager. I love the way they find these themes, the way they choose stocks to monetize those themes, but also their communication, which is great. I love their videos and the interviews which Cathie does. Those are really quite illuminating. I do have some issues with them. I don't think the returns that we saw in 2020 are sustainable. We are probably going to have a rough ride in future, but if you're willing to stick with them, I think they're a great fund manager. Although I don't invest in active funds myself, if I did, I might go for something like them or Scottish Mortgage, which is their UK equivalent. So I hope you found that useful. We do our best to keep our content useful and informative. You can always sign up for our free weekly market roundup. It's delivered to your inbox, and of course it's free. You'll find a link in the description below me and above me. And as always, thank you for listening.